Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today, ask yourself, are you looking to add some new dividend stocks to your portfolio? Well, you've came to the right place. We're going to be covering the best dividend stocks going ex-dividend next week. So if you are brand new to the channel, I do make stock market, personal finance, and real estate investment videos weekly, so consider subscribing for future videos. So today, I'm going to be covering the best dividend stocks going ex-dividend October 8th through the 12th, 2018. The 5 stocks I have this week are AbbVie. This is a healthcare industry. It's a drug manufacturer. Pretty popular among others, Abbott, Pfizer, and a few others. So next we have AFG. This is the American Financial Group. They're in the financial sector, and they deal as far as property and casualty insurance. We have Flick. That's the first of Long Island Corp. It's in the financial sector as well. Industry is, Northeastern banks. It's a regional Northeast bank. We have MMC, which is the Marsh and McLennan Company. They're in the financial industry, financial sector as well, and they deal with insurance and such. And then last we have Raytheon. This is ticker symbol RTN. This is Raytheon. It's in the industrial goods sector, and its industry is aerospace defense. So all of these are dividend stocks going ex-dividend next week. Now, all of these stocks were screened for yields greater than 1.5. They all have had rising revenue, net income, free cash flow positive over the last 5 and 10 years. Their forward PE earnings are expected to be less than they currently are, meaning that their earnings are expected to grow. And of course, their next year earnings per share are expected to rise greater than its current earnings per share. And of course, that kind of plays into the earnings. And they've grown their dividends for the last 5+ years. Some of these stocks have grown their dividends for 10 or more years. I believe all of them but one. So quite a good list today. And of course, we cover dividend dates, price comparison to the yield, PE comparison to the industry, and the S&P 500, their payout ratios, dividend history, and a few other items. So if you're looking to get started, you haven't got started in your investment journey, looking to get into the stock market, check out M1 Finance. I do have a couple referral links in the description below. And let's go ahead and get started. So all of these stocks are ordered by ex-dividends October 8th through October 12th, 2018. These are numbered 1 through 5, but that is just in the order that they go ex-dividend. I also have a free dividend calculator for Android. I'm an app developer. I put out a calculator that allows you to put in the price, the dividend payout, how long you're going to be adding to the stock, either weekly, monthly, etc. And it kind of spits out some calculations there. So interesting one. It's got over 200 downloads now installed. So number 1 stock we're going to be checking out is Raytheon Company. It's a defense contractor specializing in technology-based products and systems. It serves both domestic and international customers in defense, homeland security, government markets, and it operates in 6 different segments here, which you can kind of read off there. Its ex-dividend is next Tuesday, the 9th of October. You would have to buy this one on Monday or prior. You would then get paid out on the 8th of November of 2018. Now, this is the graph here showing the movement over the past 10 years. In the blue, they've had 209% dividend growth over the last 10 years. If you take these numbers, divide it by 10, which is the time frame, that'll give you your average return per year. So on average, Raytheon has increased their dividend by 20.9% on average per year over the last 10 years. That's a very nice dividend increase year over year over year. Here in the orange, we have their price change over the past 10 years. They're up 287.2%. This doesn't include that yield that's paid out to you. So that's an average return per year of 28.7%. Here in the check out their revenue, up 12.02% over the past 10 years. So a little bit slowed. We've been in a pretty mild, this is the aerospace defense, so we don't have that Space Force out there yet. So net income here has been a little low at 12.02. That's about a 1.2% on average per year, so not a whole lot as far as revenue. In the green, we have their free cash flow up 62%, and in the purple we have their net income on average up 4.3% on average per year. Now looking just at their 1-year graph here, they currently pay out 86 cents per share per quarter. They're currently priced at $205.88. Their current yield is around 1.62, 1.67, depending on the day and where that price currently sits. You can see the yield for the year is currently higher than the price. The current PE is at a 24.83, and its forward PE is expected to fall down to a 20.7. Its price to book is at a 5.53, and its price to sales is at a 2.29. So when looking at the above graph, it does show the current stock does have a higher yield over price, which may indicate it could be undervalued at this time. The stock is also trading below the industry average of 25.4 and below the S&P 500 average of 25.33. It has a payout ratio of 34.9, which puts it below that 60% threshold, and it's had dividend growth for the past 13 years. Its price to book value is a little high at 5.53, but if you look at its price to sales at a 2.29, this is, the price to book is slightly higher than 3, where value investors would consider it a value, but this is sort of a defensive and basically a little bit not so much on the price to book. This would be more on the price to sales sort of ratio, rationalizing it by. So currently trades around the 24.83, industry 25.4, S&P 25.33. Current dividend, which we've already covered, they pay out $3.47 per share each year. Their payout ratio at a healthy 34.9, and they've been growing their dividends for the past 13 years. Since 2005, they did cut their dividend. They stopped paying a dividend between 97 and 2002. Then between 2002 and 2005, they froze their dividend, and then they continued to raise their dividend since 2005 for the last 13 years. Number 2, we have Flick. This is the first. It's a one bank holding company. Its services include accounting, reconciliation, services, bank by mail, personal money orders, bill payment, remote deposit, and so on. They do a lot of, it's a financial institution there. Ex-dividend date is on the 9th of October, which is next Tuesday as well. This one has a payout date of the 19th of October. If you wanted to buy this one for the ex-dividend or to keep it in your portfolio, you would have to buy this one on Monday or prior. You would then get paid out on the 19th of October. This one shows a little bit more growth over the past 10 years, double digits here. So in the green, start at the top, free cash flow up 314% divided by 10. That gives you your average return per year of 31.4. In the purple, we have their net income up 195%. Or 19.5% on average per year. Very nicely grown company here. You can see everything is basically in the triple digits, and if you divide that by 10, you get at least 10% on your dividend, your price, your revenue, your free cash flow, your net income on average per year. So very healthy looking stock there. Checking out its 1-year performance here, they currently pay out 17 cents per share each quarter. They're currently priced at $21.50. That gives them a current yield of 3.18. This is showing 2.79, but that was because they were currently paying out roughly a 15-cent dividend. They recently increased it from 15 cents to 17 cents, putting them at a new yield of 3.18. Their current PE is at a 14.14. Their forward PE is at a 13.21. Price to sales is at a 4.96, and because this is a financial, they're usually between 1.4 and 1.7. This one is at a 1.46. So when charted, it does show the current stock does have a higher yield over price, which may indicate it could be undervalued at this time. The stock is also trading below the industry average of 15.1, below the S&P 500 average of 25.33. It is also sitting below the 60% payout ratio. It's sitting at 41.2. It's had dividend growth for the past 11 years. Its price to book is at a healthy 1.46, which is below that 3.0 value, where value investors would consider a value. So some of the main things here, they pay out 68 cents per share each year, or 17 cents per share each quarter. Their payout ratio, again, 41.2. This one has been raising their dividend for the past 11 years. What had happened back during that recession, they did a stock split, and they had been paying out semi-annually around 12 cents, somewhere around there, and then they cut their dividend to be paying out quarterly. So they were paying out about 12 cents at a semi-annual level, and they cut their dividend to quarterly and started paying out about 3 or 4 cents per quarter instead of that semi-annual payout there. Number 3, we have ticker symbol MMC. This is the Marsh & McLennan. They provide advice and solutions in the areas of risk, strategy, and human capital. It operates through 3 segments: risk and insurance services, consulting, and risk consulting and technology. This stock's going ex-dividend next Wednesday, the 10th of October. You'd have to buy this one on Tuesday or prior to be able to capture that dividend on Wednesday. The payout date is the 15th of November. Again, we have all triple digits here except for the red, which is the revenue. Revenue up about 3.7% on average per year, 37.75% over the past 10 years. You can see all the other numbers here, though, are very, on the bright end here. So in the purple is their net income. Net income has been growing, while there's their revenue may not be growing, but their net income here has been growing up 42% on average per year. So that's a very healthy return on their net income. In the green, we have their free cash flow up 201%. In the orange, we have their price. So their price has gone up on average per year about 19.8%, and they've raised their dividend by roughly 10.7% on average for the past 10 years. So healthy looking company there. Taking a look at their 1-year performance, they currently pay out 41 cents and a half cent there per share each quarter. Currently priced at $83.40. That gives them a current yield of around 1.99, 1.85%, depending on the day. They currently, let's see here, in the blue, this one's a little bit different. Okay, no, it's their PE ratio. Their current PE is at a 26.06. Their forward PE is at a 19.42. Current price to book is at a 5.45, and their price to sales is at a 2.9. So this is more of a sales company. They're trying to sell, they're providing services of some sort instead of a financial. So when charted, it does show the current stock does have a higher yield over price, which may indicate the stock could be undervalued at this time. The stock is also trading below the industry average of 30.6, and it is currently trading above the S&P 500 average of 25.33. It is sitting below the 60% payout ratio, sitting at 38.6, and it's grown its dividend for the past 8 years. Its price to book is slightly high at 5.45, which is above that 3.0 value, where value investors would consider it a value. So they actually locked their dividend out during the downturn. So during 8 years ago in 2010, they paid out a dividend between 08 and 09, but then they just locked out their dividend. During the downturn, they locked out their dividend, and then 2010, they began to raise their dividend after that, after they had the money on hand to begin paying out that dividend again. So some investors, they don't like to look for stocks such as General Electric and a few others that cut their dividend instead of just locking it out. Some people prefer them to just kind of lock it out. AbbVie, it's a pharmaceutical. They make pharmaceutical products. It's a product line including treatments for health conditions such as arthritis, paralysis, Crohn's disease, HIV, and other items there. They're a split off of Abbott company. Let's see, Abbott ABT, I forgot what the actual extension of the whole name is, but they're going ex-dividend next Thursday, the 12th of October. You would have to buy this one on Wednesday or prior to be able to capture that dividend and get paid out on the 15th of November. This one here, you can see, start at the top, we have their price up 18.1% on average per year, over 100, at 181% over the past 10 years. Dividend has gone up 14% on average per year. In the green, free cash flow up 9% on average per year. In the red, their revenue up 6.69% on average per year. And their net income here is at a 20.32% over the past 10 years, or about 2% on average per year for their net income. They recently did have a big dip in their price here. You can see their price came off all-time highs. I believe one of their trials for leukemia had gone back to the drawing board, which caused their stock to kind of fall. I believe they were trading in the 60s now. Maybe they were trading a little bit higher. Here we can see they were trading in the $112, $115 point before falling back down, now in that $95 point. So taking a look at the stock here for the year, they currently pay out 96 cents per share each quarter. You can see they have had huge dividend raises recently. They're currently priced at $95.11. Current dividend yield at 4.04. They've actually broke above that 4% yield right now. That's because their stock, they raised their dividend from 72 cents per share and some change to now 96 cents per share. That's a huge dividend increase there, bumping them over a 4% yield. I know a lot of other investors out there that are dividend investors over at the PPCEN channel. I know he talked about Abby in one of his recent videos. Price to book is currently sitting at a 41.3 price to book 41.38. Price to PE ratio 23.54. Forward PE is at a 12.09, and a price of sales at a 4.9. So when charted, it does show the current stock does have a higher yield over price, which may indicate it may be undervalued. At this time, the stock is above the industry average of 12.09, below the S&P 500 average of 25.33. This stock is trading below a 60% payout ratio. It has a 48.9% payout ratio and has had grown their dividend for 45 years, but it's not them themselves that have grown their dividend for 45 years. Their parent company, which was Abbott, had grown their dividend for the past 45 years. Abbey was actually split from them in 2013, and since that point, they have continued to raise their dividend since that point. Price to book is very high at a 41.38. This could be an error, but it is currently above that 3.0 value, where value investors would consider it a value. The stock PE, the current yield around 4.04. It's a very healthy yield. They currently pay out $3.84 per share each year. Payout ratio, I'll have to fix that. I added that extra zero. And they've had dividend growth for 45 years, but this actual company itself has been paying out dividends since 2013. I've included that in my notes. So number 5, we have ticker symbol AFG. This is the American Financial Group. They provide property and casualty insurance products in the United States. It offers property and transportation insurance products that include inland and ocean, marine, agriculture-related, and commercial automobile insurance. Specialty casualty products, which consist of liability, umbrella, and excess liability. So I'm out there looking for an umbrella policy right now myself, so I am definitely looking to look for what kind of products they may have. That's kind of interesting. But ex-dividend date is the 12th of October, which is next Thursday. You'd have to buy the stock on Wednesday or prior. You would then get paid out on the 25th of October. Here, these spikes here in this dividend is that they have had special dividend payouts. So on average, they've actually increased their dividend about 18% over the last 10 years. But there are times, every few years where they will say, hey, we have a lot of money on hand. Let's go ahead and pay it out to our shareholders. And they will pay out a chunk to their shareholders at a time. So interesting, a few other companies do this as well, those special payouts. So here in the orange, their price has gone up 588% over the past 10 years. That's an average increase of 58.8% per year. That's not including their dividend payout that they include. That's taken out of the price per year. Their dividend is up 18% on average per year. So very high priced, high price growth, growing company. And also they've been raising their dividend at a very healthy rate of 18%. In the purple, their net income is up 171.7% or 17% on average per year. In the green, their free cash flow up to 121% or 12.1% on average per year. And the red, their revenue is up 65% or 6.5% on average per year. So American Financial, they're very healthy looking stock there, especially with their price and their dividend increase there. It's an insurance company, so they offer a lot of products that people out there are needing. And it's not just in one specific sector, for vehicles, it's also marine, property, transportation, and they offer a variety of products there. So very interesting company there. One to check out. So for the past year, this company currently pays 35 cents per share. They recently had a huge spike here. That is because they probably had some more money on hand. Instead of being taxed on it, they paid it out to their shareholders. This one's currently priced at $110, gives them a dividend yield of 1.27%, but they raised their dividend maybe here. It shows that this is yield as 1.45, pulling it off from dividend.com. Their current PE is at a 18.71. Forward PE is at a 12.79. price to book is at a 1.92, price to sales at a 1.4. So when charted, it does show the current stock does have a higher yield of a price, which may indicate it may be undervalued at this time. The stock is trading above the industry average of 17.4, but very slightly over, and it is trading below the S&P 500 average of 25.33. The payout ratio is at a 18.8%, which is way below that 60% threshold, meaning that if they lost half their earnings, they could continue to pay out that dividend from their earnings and be completely fine. They've had dividend growth for the past 10 years. 12 years ago, they cut their dividend by half. And then, let's see here, why am I getting those? And then between 01 and 12 years ago, they kind of froze their dividend during that time frame. So say 12 years ago, that would be 2006. They froze their dividend during the downturn, that recession. They cut their dividend by half and then froze it, and then just continued to raise it about 12 years ago, back in 2006. Just slightly raises there, but you can see here over the past time, they've increased it on average about 18% there. The company's price to book is at a 1.92, which is below that 3.0 value or value investors, but it's considered a value. So dividend yield currently 1.45. Annualized payout, they pay $1.60 per share each year, 18.8 payout ratio, and again 12 years of dividend growth. So 4 out of these 5 stocks this week have been paying out dividends for the past 10 plus years. So that is basically it. I hope you guys did enjoy this video and this article. If you guys haven't checked out my website, I create these articles every single week and release them usually on Monday or Tuesday, and then release my video on Wednesday. So of course, if you did like this video, you go check out my website, you do like the article, remember to share it with your friends on Facebook and Twitter that really like in investing in dividends. So that is it for this video. As a friendly disclaimer, I am not a financial advisor, tax professional, any sort of professional on any level. The information provided is my opinion for entertainment and fun. This is just me as another financial investor trying to help others make their money work for them. And that is basically it for this video. If you have any other questions, suggestions, let me know in the comment section below. And of course, if you are brand new to my channel, I do make stock market, personal finance, real estate related videos weekly. So consider subscribing for future videos. And of course, if you did like the video, hit that thumbs up button below. I highly appreciate it. Thank you guys, and I will see you next time. Have a great day. Bye.